what happens when the world's fastest growing economy suddenly hits a wall?
If a company is relying on China for any type of material,
if you slow China down, the world slows down.
China has risen to become the world's second largest economy through an incredible 40-year economic boom. From 1980 to 2019, China's GDP grew at an impressive rate of over 9% annually, lifting more than 800 million people out of extreme poverty during this period. However, this period of prosperity may be nearing its end. Despite these challenges, China's geopolitical rivals shouldn't be celebrating. China is the top trading partner for more than 120 of the world's 195 countries, meaning that any trouble in China will have global repercussions. Before we get to that, make sure you subscribe to our channel so you never miss out on any of our interesting videos. China's economic reforms of 1970s. The story of China's astonishing economic growth begins in the 1970s when leader Deng Xiaoping introduced a series of bold economic reforms known as the Reform and Opening Up. This marked a departure from China's strict centrally planned economy. However, Deng understood that he couldn't completely shift a communist country to a capitalist one without losing control, so he cleverly limited the free market to 4 special economic zones. In these designated areas, trade operated under more market-oriented principles, which attracted foreign investment, encouraged private entrepreneurship, and boosted global trade. These SEZs proved to be incredibly successful, sparking China's first wave of growth since the early 1980s. Small villages rapidly transformed into bustling cities, agricultural productivity soared, and living standards improved significantly. Cities like Shenzhen emerged as manufacturing giants. This growth also filled China's coffers because many of the successful companies were state-owned enterprises, SOEs. These are companies where the government owns a significant or majority stake. SOEs often receive financial support, low-cost loans, and favorable regulations from the government, especially in key sectors like energy, telecommunications, transportation, and finance. In return, these companies must follow government directives and meet public policy goals, such as maintaining employment levels. The Chinese Communist Party (CCP) found a model that allowed them to channel profits from private industry into their state-controlled economic vision. Moreover, if these SOEs could tap into global capital markets, their potential was limitless. So this led to the predicted step, and in 2001, China joined the World Trade Organization.
The World Trade Organization agreement to adopt the draft decision on the accession of the People's Republic of China.
China joining World Trade Organization. When China joined the WTO in 2001, it committed to following international standards like reducing tariffs, increasing transparency, and protecting intellectual property rights. This move allowed China to integrate more deeply into the global economy, attracting significant foreign investment. The impact was swift. Foreign direct investment (FDI) in China skyrocketed, with inflows jumping from $53 billion in 2002 to $108 billion by 2008. As hundreds of millions of Chinese workers saw their wages rise, they deposited more money into the banks. This influx of capital accelerated China's investment-led growth model. China's banking system operates on a principle called window guidance, where the government directs banks on how much to lend rather than leaving it to market forces. This approach has led to massive overinvestment and an unsustainable property bubble. The Chinese government has approved huge infrastructure projects, promoted urbanization of rural areas, and developed numerous export-oriented industries. Problems with the real estate sector of China. In the initial phases, taking on a bit of extra debt is manageable. It is common understanding that loans to build highways connecting major cities or constructing an airport in a city can stimulate economic growth as well as attract various investments. But China took it too far. China built an excessive amount of housing. Despite having a population around 1 billion, there are enough vacant homes to accommodate 3 billion people. There are approximately 7.2 million unsold homes, and this doesn't even account for properties that are sold but not completed or homes bought as investments but are left intentionally vacant. This overbuilding is a symptom of China's investment-led, export-reliant system. The Chinese business model doesn't work well if all the workers receive higher wages, as it would harm Chinese exports. Consequently, the easiest way for households to participate in wealth creation has been through the real estate market, leveraging up to buy properties, hoping prices will continue to rise. This has led to property accounting for over 60% of Chinese household wealth, compared to just 23% in the United States. But we have to admit that unwinding a $50 trillion real estate complexity in an orderly manner is nearly impossible. When house prices start to fall, heavily indebted houses and developers will try to sell properties to repair their balance sheets. But with fewer people willing to take on new mortgages and banks tightening lending standards, house prices drop further, creating a vicious cycle known as a balance sheet recession. China is currently cutting interest rates, but it's unlikely to help much because the demand for credit isn't there. People know that housing is overpriced, and Xi Jinping has made it clear that he won't step in to prop things up. With China's interest rates dropping while the US Federal Reserve avoids cuts, the difference in interest rates between the two countries is widening, putting pressure on the yen, China's currency. For the past 2 decades, the People's Bank of China has kept the yen relatively stable against the US dollar using a managed float system, which helps maintain a competitive exchange rate for exports. China is trying to defend the 7.20 yen per dollar level, but cracks are beginning to show. Challenges with China's energy security. To hit its GDP targets, China will need an enormous amount of energy. Already the world's largest energy consumer, China's growth demands even more. Most of China's domestic oil comes from its northeastern provinces, but the Daqing, Shangli, and Liao oil fields have been declining in recent years due to the depletion of older oil fields and the increasing difficulty of extracting what's left. China's domestic oil production has hit the ceiling at around 4 million barrels per day, leaving a significant gap that must be filled by imports. China imports about 70% of its crude oil, with major suppliers including Saudi Arabia, Russia, Iraq, and Angola. This heavy reliance on foreign oil makes China vulnerable to supply disruptions and price fluctuations. Any geopolitical events may affect these key suppliers or disrupt critical shipping routes, like the Strait of Malacca, could have severe consequences for China's energy security. A sudden spike in global energy prices would worsen China's economic challenges by increasing production costs and affecting overall economic stability. China's support for Russia in the Ukraine conflict should have been prompted Beijing to secure energy production in Southeast Asia and the Persian Gulf in anticipation of rising energy insecurity. Instead, Xi Jinping's government has been importing Russian crude in large quantities. As a result, China now holds the world's second largest strategic petroleum reserve, second only to the United States. Although the exact size of China's reserve isn't officially disclosed, energy analysts estimate it around to be 550 million barrels, enough to cover just 90 days of consumption. Debt and financial instability. China boasts the 4 largest banks in the world, all state-owned and even bigger than JP Morgan. The Industrial and Commercial Bank of China, the biggest of them all, holds a loan portfolio exceeding $3.5 trillion, much of which is tied to the real estate sector. Similarly, the China Construction Bank, the Agricultural Bank of China, and the Bank of China have significant exposure to property loans. As state-owned entities, these banks face a tough dilemma during a debt deflation scenario. If they stop lending, it could lead to widespread business failures and job losses, worsening the economic slowdown. But continuing to lend would mean adding riskier loans to their balance sheets, eventually erasing the equity of these banks. The problem doesn't end with banks. Shadow banking has further inflated the real estate bubble. Trust loans and wealth management productions have been used to bypass regulations on traditional bank lending, allowing developers to access credit even as formal banking systems tighten. These products often come with higher interest rates and shorter repayment periods, making them even more vulnerable in a property market downturn. As defaults increase, the opaque nature of these products and their ties to the formal banking system could amplify the effects of the debt deflation scenario. A sharp devaluation of the yen might be the only escape route for China's central planners. If they lower the exchange rate from 7 yen per USD to 10 or 12, they could effectively reduce the real value of the country's debt. This would make it easier for borrowers to service their debts, lowering the risk of widespread defaults. This strategy isn't new for China. They implemented a 3% devaluation in 2015. However, this approach has significant downsides. The US dollar reserves held by the government and private companies would lose value because the yen wouldn't stretch as far in international markets. This would make importing essential items like energy, food, and industrial imports more expensive. Additionally, it might not boost exports much, as China is already facing accusations of dumping goods and increased tariffs. Lowering the cost of Chinese exports would likely lead to even higher tariffs from trade partners. A Chinese economy experiencing soaring inflation, shrinking wealth, and energy security is like a sinking ship. If the government chooses this path, CCP policymakers would need to act swiftly, as a yen devaluation can trigger capital flight, where wealthy individuals move their assets out of China to protect against currency depreciation. A rapid intervention to save banks, devalue the yen, and peg it to gold could eventually restore confidence. but in the short term, global financial markets would face severe volatility. So let's wait for the time to unfold this bitter reality, and that's all about today's video. If you liked the video, give it a thumbs up and subscribe to our channel to stay updated with our exciting videos.